Welcome to today's presentation where we have the pleasure to present MPC Energy Solutions. To help us through today's presentation, to give an insight into your company, your Q1 results, and maybe the expectations, we are joined by CFO and interim CFO Stefan Meisner. As always, you are welcome, very welcome to ask questions in the box down below. During the presentation, we will take the main part of the questions in the end. But if something fits, I will fit it in. But Stefan, I think the results was quite nice, so I will hand the word over to you.
Thank you so much, Michael. It's good to be back. Welcome to everybody joining the call, and welcome back to those joining for the second, third, or fourth time, depending on how long you've been following us. For those of you who are new to our company, I'd like to really spend just a few minutes to share what we're all about and what our business is, and then we will talk to the actually very, very good Q1 results that Michael already referred to. MPC Energy Solutions, we're still a fairly young company. We were founded 3 years ago. We went public when we were established on the Oslo Stock Exchange. And we are what we call a full cycle independent power producer in the renewable energy field. That means we develop, build, own, and operate renewable energy projects like solar photovoltaics, wind onshore, or projects that we combine with storage technologies, which we believe in the future will be the new normal. And we are already prepared to take on that challenge and that new growth phase. Our primary focus is on developing green fields and then farming down, as we say, or selling part of the projects once construction starts. And then we build the projects together with partners. And we really stay invested long term and operate these assets for 20, 30, sometimes 40 years. But since we're still very young, that is still far into the future. The region that we have selected for our rollout is a region that is combining developing and emerging markets in Central America and the Caribbean. That means we cover everything from Mexico down to Colombia and all the way into the Eastern Caribbean. Why this particular region? Well, because the energy transition is very, very relevant there as well. It's not just happening in Europe or Asia or North America. It's happening everywhere, and this region is no exception. It's a region where governments have communicated very ambitious plans to convert their energy infrastructure from fossil-based sources to renewable sources. So we see government support and very ambitious energy transition targets across the region. In most countries, we either have almost no renewable base, like in the Caribbean, that is very, very highly dependent on diesel generators, for example. In some cases, some islands, 90% or more. Or we have countries like Panama or Colombia, where you already have a fairly large installed renewable base, but it's undiversified. It's based on hydro. And in years like this, where you have extreme droughts, of course, hydro energy is not reliably available. So these countries need to make sure that they diversify into solar, into wind, into other technologies. Overall, the mix that we see contributes to a region where we see some of the highest electricity costs in the world, both in generation and, of course, what the end consumer pays when using electricity in his or her household. And this higher price level compensates us for some of the risks that we take when we invest in developing and emerging markets. So overall, we see a very, very favorable market environment. We've been there for a while. We're a very well-established brand. And overall, the projects that we have developed and built so far demonstrate that we have actually built a solid track record. So what have we done? Our portfolio today is an 18 megawatt portfolio consisting of 5 projects, mostly solar PV. And we also just started construction of the largest project to date, a 65 megawatt peak solar PV plant in Guatemala. It's our largest project to date. Once it's finalized in the middle of next year, it will double our capacity, it will double our energy output, and also tremendously impact our overall group revenue and profit margins, of course. Looking at the portfolio today, how do we sell electricity? Well, we do so by signing long-term power purchase agreement with off-takers. This could be private utilities, industrial clients, or public power utilities. And the average lifetime of these contracts at the moment is roughly 15 years. And if you look at the expected contracted revenue of these projects, it's way in excess of $500 million over this average 15-year lifetime. And the good news also for investors who are not that familiar with the region and believe that some currencies in the region are quite shaky, well, we are mostly US dollar exposed. A substantial part of our projects exclusively trade in US dollars, both on the income and the expense side, with the exception of Colombia, but Colombia also plays a relatively small role in today's portfolio, and that role will become even smaller once the Guatemala project is connected to the grid.
Yeah, because actually there is a question on the currency side, and one of the questions was, is there some currency risk that we should be aware of as investors? And the secondly is this, there's a thematic in the market that the US dollar will rise. I guess that will be a value creator for you, being a Norwegian company and having most of your income in US dollar. I know you report in US dollar, so it's a little bit more hidden, but is that a fair assumption that's there's no difference between your cost base and so on in US dollar, so your earnings is US dollar? Is that correctly understood?
That is fully correctly understood. I mean, our functional currency is the US dollar. We report in US dollars. We run our business in US dollars. So we're certainly not, let's say, at a disadvantage when a strong US dollar appears. In relation, of course, to the Colombian pesos, I mean, this is really the only foreign currency exposure that we have. When we built these plants, that's mostly in US dollars, so there we have no risk. And for the local expenditure, we would actually benefit from a weaker local currency. It becomes a question when we start to take money out. And of course, the moment that we take Colombian pesos out, we want to convert them to US dollars. A weaker US dollar, relatively speaking, is helping our Colombian projects. But overall, we are fine with the exposure that we have. And we also anticipate that in the long run, the US dollar will be the stronger currency in the mix. And we will continue to focus on securing US dollar-based contracts and US dollar environments for our projects, which is also why Colombia is, for this and of many other reasons, no longer a core market. So we also don't plan to add any Colombian projects to our portfolio.
Perfect. That was about the currency risk.
Terrific. Now, when we look at projects, what are we looking for? Well, we know that we need to secure high returns on the money that we invest to properly reflect the risk that we're taking when investing in emerging and developing markets, even if we are investing in very, very stable and well-known and proven technologies, because ultimately the PV modules that you're using, the inverters that you're using, all the other equipment that you're using is manufactured by the same companies that you would also see when you build a PV plant in Europe, for example. So there's no added technology risk, but of course we are still in emerging and developing markets where we need to be compensated for the additional risk of perceived instability that we're taking. We're exclusively focused on large-scale utility greenfield projects. That means we don't want to buy projects from third parties. We want to originate them ourselves and develop them ourselves. And once they reach ready to build, we want to sell part of the asset, bring in a co-investor that is able to pay us a development fee, and at the same time share some of the equity that is needed to build the project. And of course, ultimately, everything depends during the operational phase on mitigating two major risks. Risk number one is the project needs to be properly run, properly maintained, properly operated so that the technology risk is mitigated. And the other part of the equation is that the off-taker we're selling energy to for a long period of time needs to be able to pay its bills. And that's why we also spend a lot of time selecting the right off-taker and making sure that the credit worthiness is relatively high so that we don't necessarily run into the risk that we have to recontract the PPA before it actually ends, or that we have to be exposed to the spot market more than we would necessarily like. So selecting these greenfield returns by developing and taking money off the table once the construction phase starts, that's really the core of our business model. We are not a pure play developer, but we are certainly very development centric. And we consider building up a portfolio a great opportunity for long-term cash flows, and also something that helps us cover our overhead and ongoing development spending. So we need to maintain the balance between developing greenfield, taking money off the table, but also scaling up the portfolio bit by bit. And we do so by really being present in the region with a very small, eager, and lean team that has the networks and that helps us originate these projects that we need. And this brings us to the first quarter of 2024. For those of you who don't know, 2024 is really the very first year that our entire portfolio is operating on a full year basis for the very first time. So in the past, the results that we've published, while they were also good on a project basis, they were not truly reflecting what the portfolio is capable of. And 2024 will really be the first time that we can measure our performance against what we believe these projects can deliver. And we don't have to account for any one-time adjustments or partial contributions from projects. And in the first quarter, which was a record quarter for us, that's what happened. Energy output is up significantly, nearly doubled compared to the same period last year. Revenues are up by 70%, and project profits measured in EBITDA are also up. And we're now also seeing, with some one-time effects from last year being evaporated and some projects being successfully restructured, that margins are slowly improving. And of course, we want to get them to a level where we are in the range of 75 to 80%. And this will happen during the year. The first quarter is commonly where we have to spend a lot more money on the projects because you have some annual fees for insurances and others, like audit fees, that are fully accounted for in Q1. And that usually, holds down margins in Q1 a little bit more. But during the year, that effect goes away, and we should get to levels where we believe we should be. And of course, in our solar-centric portfolio, the months of May to September are the most relevant anyway in terms of generating output revenue and profits. So in Q1 and in Q3, that's really where you will see the full effect of what a fully operational portfolio of MPC Energy Solutions can do. In the past, we've been criticized that our organization and our overhead was too big for the small portfolio that we were building. And at that time, that may have been true, but it was based on a different growth assumption that we have. Now, in a different interest rate environment, we acknowledge that we need to right-size the organization to the existing portfolio without threatening future growth potential. And we have done just that. In late 2023, we introduced cost-cutting measures. And in Q1, we already see that costs for personnel and overhead are 30% below previous year first quarter. And this is a trend that we will continue to see, that we expect to see for the entire year, so that we can actually bring down overhead and personnel to a more appropriate level to make sure that we're also turning a profit on corporate level. And that's exactly what we already did in Q1, even on a consolidated basis. So not just looking at the economic share we have in these projects, but really looking at the IFRS numbers. Revenue is up by over 50%. Costs are significantly down. And for the very first time in our history, we are reporting a positive group EBITDA on a quarterly basis. And this will continue throughout the year. And even though the EBIT is still negative on group level, with strong Q2 and Q3 results from the projects, this will also improve significantly. And it would be very surprising for us at this point if we couldn't break even on a group EBIT level in 2024 for the first time, and also continue the trend of showing positive earnings per share, which we have done in the first quarter with 2 cents. Also, let's say, something new for us. And then looking a little bit more at other parameters that we use, our total assets are over 120 million. The change quarter on quarter, year on year is not that big. But what is very important to note is that we are still mostly equity financed, which is not usual in the industry at all. We would normally target an equity ratio of, let's say, around 25%, which is common in the industry, which is closer to our peers. But because we built most of our projects when interest rates started rising and we decided to finance them all equity, there's still a lot of room for improvement by financing the existing projects with debt, which is what we will try to do over the coming years as interest rate environments ease up a little bit. And this is a great upside for us, because debt that we bring into an unlevered project can immediately be taken out of the project. And it is free cash that we have available to continue further developments, new investments, or ultimately cash out to our shareholders. The free cash position we have right now, and this is money that we can spend on new developments, on overhead for new investments, is around $12 million, a little bit below what we reported at the end of last year as we continue to spend money on development and other activities. But it's also enough to really help us build the San Patricio project, which will be ready in the middle of next year, and to pay overhead and to continue developments as we see them in our pipeline. And based on all these great results, we really have no reason at the moment to change our outlook for 2024, where we expect output to be tremendously up, revenues to grow by more than 30% year on year, and our project EBITDA to nearly double. And of course, with the now lower overhead structure, only to be significantly positive on group level. One thing that potential investors, shareholders should keep in mind is that the San Patricio project, our Guatemala 65 megawatt plant that we're currently building, construction has started. The teams are now ready to mobilize to the site. The project is fully financed with equity and debt, and we expect to be connected to the grid latest in the middle of next year. This project will be transformational for us. Even if we sell part of it to a co-investor, which is our plan, we will still see a significant increase in capacity, in revenue, in projects profit, and we don't need to add any additional overhead, any additional personnel to achieve this, which is a true testament to the scalability of our business. And to conclude my prepared remarks, what I would like to say is that it is interesting to invest in our company. Renewable energy stocks may not be in favor, haven't been for a long time, but I think we've really built something that is relatively unique. We have a strong exposure for the ongoing energy transition and the renewable energy in a high growth region. We cover the entire value chain, and the greenfield returns that we can generate by successfully developing projects and then selling them once they become ready to build in whole or in part, that's really the core of our business model, and it creates significant value for shareholders. And we do so backed by our strong presence in the region. A presence that we can pay for because we have an existing portfolio with long-term predictable cash flows with high margins, and we target an equity IRR of above 15% that compensates us for any risk that we're taking. And of course, we want to look way into the future. We do have a strong development backlog of over 300 additional megawatt under development at the moment, and we can use this to solidify our growth and to make sure that we don't stop after Guatemala, but that bit by bit, we grow into a really big IPP in the region, a force to be reckoned with, and ultimately an IPP that generates long-term predicted cash flows for its shareholders. Michael, this concludes my prepared remarks. Thanks everyone for listening, and I'm more than happy to take any questions that you might have.
There's a question here. Is the build cost on the San Patricio project fixed already? You know,
Yes.
do you know the development cost? Have you hedged your build materials and everything? So, or
Yes.
could you take advantage of if the prices go lower on, which is kind of the trend we are seeing now on some of the materials and the solar panels?
Yes, so the financing costs and the construction costs are fixed. We already made the down payments and issued the purchase orders for the turnkey EPC contract and for the material like modules, inverters, and other equipment that we need. So there's no material pricing risks here. Also, no upside if we see prices going down even lower. Well, that's good for future projects, but not for this particular one. We're also accounting for some risk contingencies. At the end of the day, this is more than a 12-month construction period. Delays might happen, unforeseen events might happen, and we need to account for that. But history shows that we are very well prepared to build projects on time and in budget. So in this particular case, we don't foresee any substantial risk. At the moment, we will provide the equity by ourselves. Once a partner comes in, that partner would join forces with us. And we also have a loan secured for 80% of the costs from a local bank. So overall, we don't foresee any significant risks at the moment.
And if we look at today, we haven't focused so much on it, but you also had a strategy presentation where you talked a lot about the farm downs, the wish to do that. Are talks progressing there? I know you can't give me exact details, but this farming down, selling the projects you already have in your books and the one you're developing, are there any progresses? Do you have talks with potential investors into those assets?
Yes, we do. So as I mentioned during the presentation, new projects in Colombia are not part of our core market in the future. So the development backlog that we have there will be sold eventually. And we are really in the final stage of discussing a deal with local buyers. So during 2024, we expect to report a successful sale of that part of our business. And for Guatemala, it's of course our goal to bring in a co-investor during the construction phase. We've had exclusive talks with a potential buyer, which we have ended now, and we've now reached out to other potential investors that we had to hold off on because of the exclusivity period. Because ultimately for us, we don't necessarily need to bring in a partner to finish the project, but we want to do so because it's beneficial for us from a financial point of view. It's part of our strategy. But at the end of the day, the terms need to be right and agreeable, and we know what these projects are worth, and we don't want to undersell them because that would not be fair to our investors and to our overall ambitions.
And then there's a question: is the overhead cost level in this quarter what we can expect for the rest of the year? You know, I think here is meant, you know, your corporate headquarters cost. This level you showed you had brought it down from 1.4 to around $900,000 US. Is that a good level what we could expect for the rest of the year, or will that swing?
So we spent nearly $1 million in Q1, and I would say that Q1 is normally a quarter where we spend more than in subsequent quarters, because this is where we usually pay our insurance premiums. This is where we pay our supervisory board for their great service. This is where we pay financial audit fees and also, if applicable, employee bonuses. So I would think that Q2, 3, and 4 should come in lower. Our overall projection for this year is around 3.5 million. So that would mean we would need to see somewhat lower overhead in subsequent quarters.
And looking at your business now you will be self-funding. You will maybe you will take on new projects, new development projects, and so on. But it will be in a slower pace than earlier. Is the overhead cost that business developer? I know you have put something into the local parts of your business, but is that enough to drive your development phase going forward when you need to go into the next project and next project? Is that a recent level? Can you do what you want with this level that you have now?
Yes, absolutely.
And then there's a question: do you expect to report again on net asset value per share? I think in the old days, in some presentation, at least the one first I think I shared, you showed a net asset value. You know, what is your book value per share? You know, could you do that again? Are you starting to think about doing that to kind of show the discount that your shares are trading at? And can you give us a little bit about your feel on how you think that your portfolio has developed from that you built it until now?
Yeah, all right. So of course we can bring back the view on what that means on the net asset value per share basis, based on book values and also what we consider to be the fair value. Have assets valuations changed over time? I think the answer is yes, because interest rates are up. That usually pushes down valuations. But at the end of each year, we do, of course, valuation assessments also to make sure that we fully cover any potential impairment risks. And there's still a lot of headroom between the money that is invested in these projects and shown in our books and what we believe these projects would yield in the open market, even with interest rates being so high. So why our book value, the NAV per share, is around 31, 32 NOK, so 3 times what the stock is currently trading at nearly. And we believe the fair market value is higher. And if it helps the investment community for this to be reported, then we will, of course, be happy to include it in future presentations. So at the end of Q2 in July, when we report on the ongoing progress.
At least that's a request here to kind of show it, you know. I think it's was Sparbanken who called you unjustifiable cheap, but maybe that will help. That will help on the understanding, because there you have to, but besides showing what is on your books, you also need to show your contingent liabilities and so on. So,
right.
So maybe that will give a viewpoint. At least it's a suggestion here from the audience doing that.
It is a good proposal, and I would also like to add that our colleagues at Sparbanken, they're usually quite right with what they're writing.
And then in the end, you know, there's a lot of talks about, you know, something I have met when I talked about your share is that you know, yeah, the region is always, but people feel more comfortable with the green agenda being driven in Europe and in such countries. But my counter argument has always been that of course it's green what you do, but in the countries where you are, there's more energy security. It's more that projects needs to be in some places because the grid is not. Is that correct, or are you also driven by a green agenda? Is it more energy stability or security you are driven by in this region?
Well, I think it's a great combination. It's a high growth region. Energy demand is climbing, and of course, especially since the start of the Russian-Ukraine war and what happened, macroeconomically and then on a global level since, these countries also understand that relying on third-party sources to deliver oil, LNG, or other kind of fossil fuels might not be as secure as they thought they were. And in a region where you have long coastlines, which are ideal for wind sources, where you have strong irradiation, where solar PV just makes so much sense, and as you build the grid where you also can stabilize that by deploying batteries, I think it is both a necessity and just a very reasonable opportunity business-wise for these countries to wean off expensive sources, fossil-based, and transition to the cheapest form of generating electricity that we have, which is solar PV. Of course, in these countries, the grid also needs to be improved. At the end of the day, this is also, as part of the energy transitions, what governments and state-owned utilities and private utilities are trying to do. And at the moment, we don't see an issue, at least not in the countries that we operate and the projects that we have, that we generate power, but we cannot feed it into the grid. The grids that we feed into are actually quite stable already. There are countries like Honduras where I would think it's a little bit more difficult and more work needs to be done. And the second thing that I'd like to point out is that these regions, which are relatively small compared to North America, compared to Europe, they understand that the energy transition for them is a necessity, but they also believe that they are not the ones who can change the world in that sense without the industrialized nations doing it first. So when we talk about locating technologies there, like storage technologies, they want this to happen in the industrialized world first, see that it works, see that it's actually technology that you can deploy at relatively low cost. So I think we will never see the region being a first mover on these new trends that we need to adjust to in the renewable sphere. But once something is proven, they're more than happy to also deploy it throughout their countries. And that's why we benefit from the strong demand for clean and affordable energy.
And then last question, then I'll let you off the hook. I was looking at you, as you already mentioned, you have a very high equity ratio. You want to bring it down. Of course, that will give shareholders some more return. You have an IRR expectation of 15%. I guess the interest is still not 15%. So my question is, it can make sense to wait for interest being lower, but is there also something else that could drive it, that you would do with your better cash flow profile or something like that, should also be able to make you refinance? And at some point in time, even if interest is not coming way down, it must still be interesting with an IRR of 15% and at such a high equity ratio and a normal project level being, as you said, 20 to 25% equity. So any thoughts about that? Do we need to sit and wait till interest has come way down, or could something else change that you could actually go out and finance some of your company with that, raising the equity or the returns for the shareholders?
Right. So I think we don't have to wait for interest rate levels to come way down, but I think there's also a different answer here. The biggest unlevered project we have to date is in Colombia. In Colombia, inflation remains tremendously high.
Yeah.
So interest rates are actually much closer to our 15% threshold than in other countries. So in these countries, we really need to wait and see that inflation comes down and interest rates come down with it. On a corporate level, of course, it could be attractive to issue a bond in the future, replace some of the equity. And as long as that bond is not priced in double digits, I think it could actually be very interesting to do that. But I would also say that we probably would need some more scale. So the San Patricio project in Guatemala should connect, so that we don't issue a bond and then we are under constant pressure to use all of the cash flows from our project to repay the coupon on that. So I would like to see some kind of a leeway for us that we can lock in more or less fixed debt costs, but that we are also sure that the existing portfolio can cover it if push comes to shove.
That was the last question. Thank you, Stefan, for taking us through your company, and thank you for presenting your result, and thank you for people listening in. May everybody have a nice day.
Likewise, thank you so much.